Ladies and gentlemen, please be seated. We are going to get started. C'est bon. Now, let's have a look to the monetary side, and so obviously important nowadays in Europe and in the US. And in both cases, I would start with just a reflection. What a mess. Traditionally consensual, the monetary policy has become highly divisive, both in the Europe and the US. In the US, President Trump keeps on harshly criticizing the Fed, while in Europe, the latest measures taken by the ECB's departing president, Mario Draghi, are far from arousing the usual support among the governing council's members. Indeed, a few of them have publicly disagreed, and one, also member of the board, has resigned. As a result, Christine Lagarde is to take the helm within a few days of a crucial institution deprived of consensus, except one. Monetary policy has done its job. The policymakers must now fiscally do theirs and take the lead to fight the recession looming over Europe. In this challenging context, what are the investors to expect, and how should they brace for the next possible monetary moves? Let's try to shine a light in this tunnel with our distinguished panelists. Let me introduce you Gilles Moek, Chief Economist, AXA Group, Wim de Wilde, Group Chief Executive Economist, BNP Paribas, Natasha Valla, Deputy Director General for Monetary Policy, ECB, and Serge Ledermann, Chairman, Schroders Switzerland Pension Funds, and Financial Advisor, Kudelski Nagra Pension Funds. Thank you to all of you. Let's start with you, Gilles. As far as the monetary debate is concerned in Europe, the basic question seems to be, are the drawbacks of the unconventional tools supposed to boost inflation from now on prevailing on the benefits? Do you agree, and what would you be done about that?
Thanks. When it comes to assessing the latest moves by the ECB, I would say we need to distinguish two things. One is it consistent? And second, is it efficient? Is it consistent? Yes. And from that point of view, it's very hard to criticize the ECB for what it has done, in the sense that the ECB is not delivering on its mandate. Inflation is very far away from its target. It has been arguing that QE negative rates was, the package was efficient, so you need to do more. So that we have more action from the ECB is normal. Now, the question is it efficient? And you have two ways to look at this. Is it technically efficient or counterproductive? Or is it psychologically efficient or counterproductive? On the technical side, first of all, I think it's always problematic to count too much on monetary policy when the root of the problem is a deterioration in external demand, when the country which is at the heart of the slowdown, Germany, is actually not very responsive to monetary stimulus at the best of time. So, and in any case, the money for your bank is not going to be very, very high. And also taking into account the fact that we are in a situation where tiering, the decision by the ECB to try to mitigate the impact of negative rates on banks, might be having some counterproductive effects, at least for the time being, on the short end of the curve. So it's not obvious that it's the right tool at the current moment, and it may have been drowned also in the noise around the technicalities of tiering. Now, the psychological effect, which for me is the most important one actually at this stage. And honestly, I think it's technically almost impossible to say at this very moment, yes, we've reached the reversal rate. We are in a situation where monetary policy is counterproductive. We'll know that in a year or two from now. We'll know that when we can actually delve into banks' balance sheets and see what their reaction is. But what is clear to me is that psychologically the effect is lost. Because let's say that the intellectual battle around monetary policy has been lost by the neo-Keynesian school, to use a complicated word, by the Bernanke/Draghi approach to monetary policy. If no one believes that it's going to work, then it's not going to work. And this is where we are now. And last thing, one very easy thing to look at was to look at inflation expectations just before and just after the decisions by the Fed and by the ECB. In the case of the Fed, actually, inflation expectations fell immediately after the easing, which is telling you that it's not necessarily super efficient. In the case of the ECB, for about 3-4 days, things improved, and then things collapsed again. So, at least for the time being, what the market is saying is, I'm not interested. And this I'm not interested, I think, reflects the fact that intellectually, they're no longer convinced.
I don't understand what you mean by I'm not interested. Is it that you should go further, or you have been you went too far?
I think, at least on the long end of the curve, the impact should be ambiguous in the sense that Draghi often says interest rates need to be lower now so that they can be higher in the future. So what you would normally expect is if you've got a big package, and it looked like a big package when it was announced, you'd expect the market after a few days to start thinking it's going to work, it's going to reflate the economy, they're going to be able to deliver on their mandate. So normally, actually, the curve should steepen after a while. And it's not happening. Because basically what the market is saying is you are changing the supply and demand conditions on the bond market, so you continue to drag yields down, and we don't believe that ultimately it will be enough to restart the economy. So in any case, we're not going to bet on a return to inflation to 2%, and you end up stuck. Yields fell, long-term yields fell, so from the point of view, the ECB eased financial conditions, but this reaction by the market, for me, reflects a growing conviction that it's not going to work.
Wim, do you share this view? Do you think we are now in counterproductive territory?
We are not there yet. Everybody is concerned that we are approaching it, but nobody knows where the borderline is. Faced with that, what do? In a way, life for people standing beside the road is easier than for those who have to drive the car. So Gilles is standing next to the road, I am, anybody is kind of that position, and is giving a lot of free advice to the ECB, and then you have to do something. Same applies with the Fed. So clearly, it is blatantly obvious that the concern is on the rise about the unintended consequences. There's a big debate going on in the Netherlands about cutting pension fund benefits. I really wonder what this is going to do to the Dutch savings rate. Now, the Dutch is just a manifestation of a broader problem. But it's a global phenomenon. Look at Japan. Regulation has changed. It allows Japanese pension funds to invest abroad in bonds. to the extent that the position is hedged, and it would be considered to be a domestic investment. So it means that this is just creating, it intensifies the global correlation. The issue that we have, I think, is that you have there was a slowdown, which I would call an endogenous dynamic. At a certain point, slowdown is inevitable. Investment accelerator at some point slows. Companies have built capacity, so they have slow investments. You have an export shock, and you have an uncertainty shock. This is happening in an environment where there is abundant liquidity and easy access to financing. So then, of course, you have a bit of a dilemma as a central bank. What do you do? Do you ease, or do you wait? Decision has been taken to ease. I understand that decision. Can have big debates on whether you should do QE or not. But I think the most fundamental thing is the introduction of the state-dependent forward guidance, which hopefully will bring back some, let's say, serenité, some kind of a more relaxed attitude about things. The sense of urgency of when is inflation going to pick up, for me, has now moved to the back burner because it's state dependent and we can be relaxed. I think you have a big problem with interpreting market developments. And this is an area where I agree with many things on what Gilles says, but this is, I would put my emphasis, my focus slightly elsewhere, because markets are typically populated with short horizon participants. And that is then driven by, do I see an opportunity to make money on a short time span? Could be 1 week, could be 1 day, could be 3 months, could be 6 months. I assume that the relevant horizon is 6 months. So it means that, for me, it goes without saying that if you have this pervasive uncertainty, to quote Mario Draghi, that you cannot expect any near-term effectiveness of a policy measure package in an environment that there was already abundant liquidity around. So for me, it's more like we are attentive, we act, and this is then creating a support for confidence to the extent that there are not other factors that are kind of rocking the boat and shaking the confidence. And what you see, and this is, I think, is blurring the interpretation of the market signal, is that bond markets, be it nominal bonds, be it linkers, that can be influenced by the evolution of how the distribution is assessed, most in particular the tail risk, and that can very much blur the signal. This is, Curé has given fantastic speeches on that, on the inflation premium in the 5-year, 5-year, which really blurs the signal. So I would not look too much at that. And then we just have to be patient. As everybody knows, the issue is that imagine that you have an additional uncertainty shock because of the hard Brexit or something else. What do you then do? Well, then we know what the answer is. Go fiscal.
Serge Ledermann, as we all know, Mario Draghi has used at the same time the 4 tools he had in his hand, which are rates, with deposit rates, TLTRO, QE, restarting full scale, and forward guidance with no limit, no seeable limits forward guidance. So negative rates are to stay and maybe are to grow. So what does it mean for an investor? I mean, you're counseling a lot of investors, long-term investors. How do you cope with this?
I'm not an economist, so I'm a former asset manager, former market strategist, and I have to preside and supervise pension funds in Switzerland that have to deliver the kind of benefits that are written in the bylaws. So yes, we have to be quite pragmatic. As you see from the picture, there's a small flag underneath my name, and we are part of Europe, but we're not part of the euro. And I think we have a little bit more experience in terms of low, very low, or even negative interest rates. The issue we have
Up to 30 years in your case.
we had a little episode at the end of the 70s. Fortunately, it was not a long episode. This one is probably longer in the teeth, I'm afraid, and we don't see by now when it will end. The issue is very clear today. If we look in the rear mirror, it's quite okay in the sense that there is a significant capital gain in our own fixed income market, but there's no return going forward. And if we look forward today, the probability that the fixed income part of a typical pension fund portfolio will deliver at best zero or probably negative. I mean, if theory holds, the 10-year return is about the level of the 10-year yield at the day where you invest. So that means a typical pension fund starting today with no history will have to rely on other assets than a typical core asset in its portfolio, which was the local bond market. And as you know, in the current environment, the Swiss franc still remains a favored currency for hedging purposes of international investors. So the risk of investing outside of Switzerland is quite high due to currency fluctuation.
So you have to reinvest mostly in Switzerland?
So a large part by law it has to be invested in Switzerland, or at least has to be hedged in Swiss francs, which is quite costly today. Hedging dollar exposure in Swiss francs, but in euro it's a bit the same, a little bit less, is between 2.5% and 3% per year, which is quite significant, which sort of erases the return you can have on a 10-year or even on a 20-year US bond. So that means you have to rely going forward essentially on other asset classes which are more volatile. So you will have to invest probably significantly more in real asset and in equities, but staying in the conservative framework that the authorities have set up. I would add one point which has been mentioned. I think the danger today is really social and political. I think we run the risk to put financial institution, insurance, pension fund close to bankruptcy. Of course, a pension fund doesn't go bankrupt, but has to adjust its program, and more unrest in the street. So we are digging more or digging more in terms of the inequality, and we are in a situation today where we see in all countries. I mean, France is a good example. With your friend of Saturday in the street, of growing unrest. And I think there is a huge responsibility at the central banks not to contribute more to the unrest. For the solution, maybe we'll speak later on.
Okay, Natasha Valla, the negative rates are now affecting around 30% of the bonds worldwide. In a few countries, much more, and especially in European countries. I saw that Greece has got negative yields yesterday on an issuance. That's pretty amazing. Is the ECB, which is heavily dovish, as we've just seen in his forward guidance, fully aware of what it means for the investment industry and its allocation to financing the European economy?
That's a multifold question, and maybe if we start with negative rates and the level of rates, short-term, long-term, I'd like to give a little bit of context. There's the conjunctural developments, and here when we look at the macroeconomy, it's true that I wouldn't qualify the communication of the ECB as overly or highly dovish, but still it's true that there's a slowdown, and there can be a consensus to say, and there has been a consensus to say in September, macroeconomic developments are warranting, both from the growth side and the inflation side, some action, some easing action, and that's what William was saying again. So this is something that I think cannot really be controversial. What can be controversial is then how do you do it? And how do you do it as a function of your starting point, and also as a function of what you think will be the impact of what you will do. Now, here we should put the current conjunctural developments in a broader context, where if you look at the time series for long-term interest rates, for real rates, for inflation risk premia that you mentioned, they're all term premia. They're all very low, some at historical lows in most advanced economies. So there are factors behind it that go well beyond what the monetary policy maker can affect, and we have to keep that into account. So, well, this being said, you have to act counter-cyclically. What do you do? And there the question, and I think it became pretty clear over the days, that the discussions are very intense. We've had some of it here. There are lots of discussions, pros and cons, in the staff, in the Eurosystem as a whole, and it's healthy to have that discussion because things are not univocal. But then what was decided was to say, well, we have a number of instruments. Some of them have been sort of put in the backyard in December last year. Others were still very, at the forefront. What do? Do we take one instrument and we express the easing of the stance through one instrument? Some might have thought about it, but in all logics, given the history of central banks and the way in which monetary policy is being implemented, your main instrument is the interest rate. So had we thought of adjusting everything through one adjustment, one tool, the interest rate, probably you would have ended with a rate cut that would have been bigger than the one that we've seen, which is this 10 basis points. Now, this is where we come to the question of the reversal rate that Jill mentioned and the effective lower bound, and do we know where it stands? How confident are we that we are getting, that we are not getting close to it? And here I would say, again, different views, but there are other jurisdictions where rates are a lot more negative. Actually, for the anecdote, we held our annual monetary policy conference on Monday, Tuesday this week, and we invited Ken Rogoff to give a talk. Now, for those of you who have read Ken Rogoff's book on currency or on cash, they will know what I will say, but he told us, look, guys, you should put interest rates at -3, -4, -5. That would work. So we're a bit more cautious than that, and I think we should go stepwise, and 10 basis points was already quite, say, an achievement. Now, together with the 10 basis points, and then I come to the package and the philosophy behind the package, there's the forward guidance. And as you mentioned, forward guidance is probably, in the package, if I had to pick one measure that is the most meaningful, it's probably the adjustment in the forward guidance on interest rates and on reinvestments, but on interest rates. Not everything is linked. And now, as mentioned, we've removed the sort of calendar-based, date-based component of forward guidance that was basically saying we'll keep rates at this level or lower to time t. That was basically useless because curves were, underpriced or overpricing us by a lot. So that was really useless. And now this sort of contingent forward guidance recomposes, concentrates the attention to something which is very explicitly linked to inflation developments and inflation expectations. Now, again, here you may say, let's dissect what's behind it. And what does it mean? I will not tighten policy before inflation goes back to where I want it to be. What does it mean if the central bank doesn't say what is the exact target? That's probably a discussion for the near future, but that discussion will come. As things stand right now, the target is, inflation close to but below 2%. Many board members, the president have said, well, this sounds asymmetric, but this is very much symmetric. So I think there's a lot of rhetorics, but plain thing at the end of the day, close to 2%, 1.5 is way too far below 2% for us to be comfortable with this number. Now, the rest of the package includes a number of other elements, bank funding. And here, again, lots of controversies about the fact that we have those long-term refinancing operations that are very valuable to banks. We now have mitigation measures with lots of discussions as to whether is there really a monetary policy case to mitigate those side effects. I don't want to give you an answer, but overall, if you think that the monetary policy transmission in the euro area is still mostly bank-based. I mean, a lot of things are structurally slowly changing, but banks are at the core of the transmission of monetary policy in the euro area. So we cannot afford to jeopardize this. And we see that, loan growth and the financing of the real economy is supported by what banks are doing, a lot more in some countries than in others. And here, this heterogeneity is a bit uneasy for us to address. It's probably not for the central bank to address, more for macroprudential national-based measures. But still, it's key to us to have those funding flowing to the real economy and to non-financial corporations. And this is what we see. And that makes us confident. As long as this goes, and as long as we can support it, we'd rather compensate those, mitigate, say, those side effects of low interest rates and negative interest rate and flat yield curves. And I should have put them in the reverse order in terms of importance. As long as we're able to balance things, we really want to protect this, hoping that during that time, banks will take, the necessary action to do the things that have not been done as quickly in Europe as it has been done in the US. So we also watch very carefully. What I'm saying here is that we are aware that negative rates are new and there are lots of unknowns. And as this situation continues, we need to be very vigilant as to how this affects bank profitability and the funding of the real economy. And we monitor very closely, bank by bank, country by country, how bank profitability evolves over time. And so far, what we see when we allocate the evolution of bank profitability to specific factors, the net interest rate margin contribution, which is negative, is much smaller than the positive contribution that we've seen from provisioning, from improvements in cost efficiency, although still here a lot more can be done. So in balance, and it's always a matter of compromising the pros and cons, things seem to us sort of on check in terms of stability. One dimension where I think we need to make some work, and we have started to look at more closely, is the evolution of the impact of the non-bank financial system. And here we very much have in mind insurance companies, pension funds, and other intermediaries, for example, investment funds that play a big role in the balance sheet of insurance companies, how those intermediaries are affected by how rates are today.
Obviously, there's a lot of work to be done on that ground. If I'm just referring to the recent outspoken declaration of the chairman of Allianz, which was really, really critical, harshly critical, and highly critical. So the debate is mounting because obviously they fear the consequences. Maybe you will comment on that, Mr. Ledermann. Nonetheless, Mario Draghi is insisting that he's got further ammunition. So he's ready to go further. And obviously, Mrs. Lagarde is on the same path, on the same thinking. What do you think about that? Do you think the ECB should or could go further?
On the should and then on the could. On the should, since the central bank itself increasingly says, well, it should be up to fiscal policy, we should hear that message. So the central bank itself considers that it doesn't have on its own the tools to deal with the current downturn. And I think we should think about the pros and cons of going further in terms of how it would change incentives for fiscal policy. And then there's a debate. There might be an approach, especially in Europe, in which you would say, we're going to make interest rates very negative, very hurtful to a number of savers, and that may tilt the decision towards fiscal expansion in the countries where a big chunk of the curve is negative, aka Germany. Let's try to force a debate on if there is no fiscal push, interest rates will remain very negative, savers will be hit. For the time being, I haven't seen any evidence that it's working. There's the very beginning of a debate on fiscal policy in Germany, but it's very, 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 very tiny. Or you've got the other approach, which is the approach advocated by Summers, for instance, which is to say, at some point, the central bank needs to say, stop. I've done what I could. It's up to fiscal policy to do the job, and I'm not going to bail you out with another monetary easing. And you can actually restart your monetary easing once fiscal policy has started to support. And you're going to make it more efficient because you're going to make it more sustainable. So for me, the should is a function of, are we certain that this would prompt fiscal policy to help? On the could, very quickly, I think that obviously, and William is right, we are on the side. It's easy for us to comment on the difficulties of the ECB. But you could argue that the 20 billion euros for QE, the new batch, is a form of reverse engineering. That it's what you can do without counting on too much net issuance, and especially what you can do without at least immediately having to trigger the real debate, which is, should we go beyond 33%? And should we put national central banks in a situation of being the deciding force in a restructuring? It's a political decision. Given the current divisions in the board or in the governing council, it's not obvious to me that the situation is politically ripe to make that leap. So if it's not obvious, you should, because you're actually asking more from fiscal policy. And on the could, things are getting really, really, really tense, and you're really at the margin of what you can do. Maybe it's time to say stop, yes.
Wim de Wilde, I'd like to hear you about the mayhem, the public mayhem in the debate. It's absolutely unusual to hear the Dutch government comment openly about the decision of the ECB. A few central bankers, and a few very well-known central bankers, former central bankers, are attacking the measure taken by Mario Draghi. We are hearing about new ideas coming from people like Stanley Fischer, for instance, in a recent note that talked about some form of helicopter money. We are waiting for a new ECB president, and never, I think, in the past has the debate been so harsh and divisive. How can such an institution like yours allocate, and for the count of the clients, the savers, how could you do to find your way, the best way?
Well, the multiplication of expressions of disagreement is, of course, a source of concern. Not only about, to quote Luis de Guindos in his speech, I think yesterday, that we worked in a collegial way, so let's respect that. But beyond that, it's far more fundamental, of course. The real issue is that it's kind of an expression of a concern. Will we still be able to do something if it would be necessary? That's really at the heart of the matter. By the way, if you allow me, it's not your question, but I will nevertheless answer the question you did not ask. I mean, when Ken Rogoff, I did not read his book, and have no intention in the near term to read it, because when he says that you have to tax deposits 4%, I really would be keen to have an explanation of the economic model underpinning it in that advice, because if you tell people I'm going to hit your balance sheet, and that way I expect that you spend more money or that you take more exposure to risky assets, of which we know to what extent it is tilted to the right side of the wealth distribution. I'm very sorry, I'm lost. It's just taxing, and you have to say it's a tax, full stop. So I'm closing that parenthesis, but I'm a bit emotional on that advice, and I have issue with it. Sorry. Yeah, indeed. So I mean, okay.
No, I
So-
mean,
Mr.
and then you have
It's-
run on banks, and that's exactly the opposite
Yeah,
of what is
so-
good. So I have little sympathy for Mr. Rogoff.
So we close that parenthesis and go back to the main point. So, I mean, we're in an utterly complex world, of course. When you have one bullet left in your revolver, I don't know, but I suspect that psychologists or whatever, or arms specialists will tell you, do not say that you only have one bullet left, because the opponent could use that
You
information.
still think there is a silver bullet in the barrel?
No. We're way beyond the silver bullet. So you can do something, okay, fine. The real question is, what is the effectiveness, and shouldn't we try to shift the debate? That, I think, by the way, is for me what I'm now waiting for, the shift of the debate. And let's be do it in a brainstorming way. If we do not, I'm not saying because we have Natasha on the panel, but we criticize the ECB, but if the ECB would have not done anything, right, to come back to the paper of former central bankers, the ECB would have not done anything. What would have happened? One, the neutral rate has dropped. We can disagree on how much, but let's say ballpark estimate, ECB occasional paper on that topic, 150 basis points since the Great Recession, and then you have a drop in inflation expectations. So rates would have been low anyhow. Now they were low in a different way. So second thing is that the element of the inability to come up to a counter-cyclical effort, counter-cyclical fiscal reflation effort. I mean, this is a big issue. And that is instrumental in making it work. It's not, in my view, it's not about Germany deciding we will build some bridges or we will manage to build an electricity infrastructure which allows us to bring the wind energy from the north to the south, which apparently is not easy that nowadays. So these are the real matters. If you the promise, the ability to promise, to act, will raise growth expectations, real growth expectations, and will reduce the pricing of the tail risk. It will mean that the negative term premium will become less negative. Bond yields will go up, the curve will steepen, there will be a sigh of relief in the non-banking sector, and people will have a possibility of buying positively yielding bonds without being forced to go to Greece. So if we can go in that direction and stop focusing all the time on monetary policy, that would be a great step. The thing I have the document with me of the former central bankers. It would require quite a bit of time to grow. There's some things I agree on some things I would say you need to be a bit more nuanced, and other things I disagree on, sorry.
Mr. Ledermann, do you think that institutional investors are to brace, unfortunately, for further fall, for the drop of rates and further laxism, monetary laxism?
Well, I would say if I look at the positioning today, they probably prepare for that. The reality may be different. As I said, I have little, if no sympathy for what Rogoff said, which is totally insane to me. I have more sympathy for what has just been said. I mean, we need to enter, and that's not the responsibility of the central banks anymore. It's been 10 years. They've done their job. Thank you very much. But what has been said earlier on, first, I mean, have the courage to say now we stop. We have done it. I mean, all what we do from here is non-productive or can be negative. And the second thing is that we need to enter in Europe, and it's your responsibility, the governments and the authorities, to re-engineer a growth strategy. And there are plenty of opportunities of investment. The only thing that is absolutely essential, and I had extensive discussion in Switzerland with the authorities on that front, is that you need to invest with partnership. You need to enroll the insurance companies, you need to enroll the pension funds in those new projects and propose positive return on those investments. Not say, because we had politicians, they said, okay, I can borrow at a negative rate, why should I take you on board? So I mean, such a vision is stupid, is irresponsible from people that have the responsibility to lead the country, and we should change completely the model. And our take...
Why would it be so important to have to set partnerships in this context?
Because, as it's been said, long-term investors need to have positive return. In Switzerland, as in the Netherlands, we have a pension fund system by capitalization. If you have negative interest rate, the system doesn't work. So, even if you put rate at 0%, it's a saving system. You put your money in a pension fund at 0%, it's like putting your money in a closet. So, it's exactly the same. So the system doesn't work anymore. So you need to provide good project with positive returns, and that is not impossible. That is fairly possible, but it requires courage and to change today the vision. Of course, diversification still is the ultimate free lunch in a diversified portfolio. So you can find other investment opportunities, but in the local currency, those are disappearing, and that's the reason why I think the mood has to be changed. Germany has to change. I mean, this fiscal Schwarz-Null approach is totally remote, and hopefully they will not wait an extra 5 to 10 years to realize how dear the economic situation in Germany is.
Natasha Valla, when Gilles argues for the ECB to say, now we stop, is it an option? And would it be useful as far as the saver's interest is concerned? Because the lowest the rates drop, the more the savers are saving. And this is obviously a very disturbing paradox. Wouldn't it be useful to tell them, listen, now there won't be any other easing decision on monetary matters? Would it be useful on the saver's point of view?
So on the evolution of the savings behavior of households, I think that's a big topic, and I would have strong views, but that's not the topic here, and it involves a lot of other factors, including pension reforms and those things. But focusing on the start of your question, is should we really stop? I think William said it absolutely beautifully in terms of the marginal impact, stimulative counter-cyclical impact of monetary versus fiscal policy at the current juncture. The current juncture is one where we do need some stimulus, but where the starting point for monetary policy is where it is. So in a sense, it's a very, textbook case study of what is the optimal policy mix between monetary and fiscal policy, and how do the one reinforce the other. The conclusion I would draw from this analysis, on which we all agree, and you said it as well, it really would be the time for countries that have fiscal space in all respect of debt sustainability, which, by the way, we're helping a great deal, to use that space to have both a structural and a counter-cyclical impact. That's not for the ECB to do that. It's not for the ECB to throw money out of an helicopter and say, I will build that bridge. I will have a distributional impact by giving to those people instead. That's I mean, in a democratic system, it should be in the hands of fiscal policy. So that's one thing. Now, the conclusion where I would have more nuanced views is that if you take for given, which we are not doing, and that's the reason why we're so outspoken about fiscal policy today, but if we were to take as given the stance of fiscal policy, should we stop? I mean, the marginal impact of what we could do further, is it really zero or negative? And here I think we need to be humble in terms of recognizing that some ways to think have come to generate some side effects, but there may be other ways to ease the stance, which, maybe the marginal impact is not as big as if we were starting from interest rates at 3% and no sovereign assets on the balance sheet. But still, I think here we can have some thinking being made on what does it mean to do QE? And what is QE? QE so far has been mostly implemented through the purchases of fixed income instruments issued by sovereign entities. Mostly, but not only. So a fair chunk of it comes through purchases of cover bonds or purchases of corporate debt instruments. So we may have some thinking about it. Is there a way to enlarge the pool of instruments that can be bought? So I think we are not there in the immediate future, but if needs be, there's still some scope to broaden the thinking. Gilles pointed to a very important institutional element in the implementation of QE. And I would say two things to this. One may be on the fact that net purchases are being restarted at 20 billion per month as from next month. Some may say it's not much. Others may say that's a lot because there's a limit to the universe of purchasable assets. Now, where do the limits come from? I mean, there's one limit which is, it's a tough one because you can only buy as much, without any other institution, there's only so much you can buy, right? Comes back to the fiscal stance and the incentives for some countries to maybe issue more debt. So that's the market conditions for buying safe assets, basically. And with the rush to safe assets that compounds onto it, the situation is difficult. But then there's another element which has to do with the institutional constraints, namely the capital key for the ECB and the issuer limits that Gilles mentioned. Again, that's still far away in the debate and the thinking, but if from a very agnostic perspective, for a currency area that as a primary goal should be to keep the currency there and alive, should you really be so stubbornly stuck with some parameters? Again, it's more my personal view even on this topic, but my perception is that if the topic comes to be discussed, there might be some reason in the sense de la raison, being reasonable in handling it. But that's a key dimension. And then on the size of Q and the purchases, I think the discussion is very timely because when you look at what happens in the US, so the US is, where the US stands in terms of easing the stance, but having sort of stabilized the balance sheet. Now, something of a completely different order happens. Repo market, interbank financing, short-term end of the curve. And then suddenly, shortage of liquidity, rates spike up. Nobody understands, not even the central banking community. It lasts for a few days. The Fed does what it needed to do. And now the Fed is restarting purchases of bond instruments to the order of magnitude of what is being done here, but for very different reasons. So I think we should not keep boxes to separate. And purchases are not necessarily akin to QE or balance sheet expansion. Or, of course, there's a duration dimension which is key when you hold the purchases for long enough. But those things need to be seen from a holistic perspective.
Time is now running out. I will just ask you very briefly, each of you, Natasha, you're welcome not to comment if you can't. What would you would be, in your view, the main mission, the main urgency that Mrs. Lagarde will find when she will take the helm of the ECB in the next few days. Gilles, can you comment on that?
There might be a case for tidying up the communication and the rules around communication by the members. That might be timely. The more on substance. I hear what Natasha is saying, and I'm not trying to over-interpreting too much what she said, but fairly quickly, I think in 2020, there will be decisions to make on how to make technically QE sustainable, if it is so chosen that it should continue. And I don't think it's going to be an easy conversation, because as much as intellectually I agree with Natasha that we should look at this in a reasonable way, it seems that tempers have flared on those 33% limit. So I'm not too sure there's going to be a walk in the park.
Wim?
Yeah, difficult question. On QE, until the very last moment, I had not expected they would do QE, because when you do QE, you trigger questions, is it working? So if you decide to do QE, do as little as possible. That was a decision, and you combine it with the forward guidance, that's fantastic, with the state dependent, that's fantastic. So for me, just keep it as it is, very low volume, and we were going to have very boring press conferences for many months to come, and that's great. Let's be a bit patient. I think the focus should be on, I would say, conditional monetary intervention that is conditional upon downturn. What do you do when you have a downturn so that you do not have to, and I hope, and I suppose you don't need to answer that, the ECB has already worked on that, but what do you do if you have, say, -1% growth across the Eurozone? And with a struggling fiscal policy because of disagreement and whatever, what do you then do? And the ability to act swiftly in a convincing way and in a legally speaking, I would say, bulletproof way, I think will make a huge difference in the depth and the length of the recession. So from my perspective, if I were in her position, this is what I would really focus on.
Mr. Ledermann, final word?
Not much to add, but I would rather change the stance and say, okay, we stop with negative interest rates. We move to the other instruments, and probably take into consideration. You mentioned that. Take into consideration that banks are important as a conduit, but there are many other financial players in this game, and take them into consideration as well.
Thank you very much indeed, ladies and gentlemen. Let me thank you on your behalf, our distinguished panelists. And now it's time to talk about another very looming issue, Brexit. Thank you to all.